Many economists and analysts say a key factor holding the economy back, a lack of credit for small and mid-sized businesses as well as for consumers. So let's talk about lending with Leonard Tannenbaum. He is the chief executive of Fifth Street Finance. They help private equity firms line up financing. They actually lend money to small and mid-sized businesses. You're here for a CEO sit-down. Len, always a pleasure to see you. Thanks very much for coming in.
It's great being here.
Tell me, first of all, about Fifth Street, because I know that you changed the listing. You were used to be listed on the New York Stock Exchange. Now you're listed on the NASDAQ. Why'd you make the move?
Well, I got to tell you, years ago, it definitely was beneficial probably to be on the New York Stock Exchange. They were specialists. They would take some risk. And we did an analysis of what the shareholders' value was getting. And what we found is we save about $500,000 switching to the NASDAQ. And that's just a lot of money for our shareholders. So we made that switch, and the stock didn't move. Liquidity looks pretty good. I think in this world of trading with the pools of liquidity and dark pools and gray pools, I think the NASDAQ is just as good as the New York in terms of providing a liquid market.
All right, so you're saving money for the shareholders.
That's what it's about.
All right, let's talk about money then.
Okay.
Tell me about what's going on in the middle markets, because your business is, you've got lending facilities, you've got an SBA license, small business license. You're the non-bank financial company in the economy. You're looking out for loans. You're looking out for businesses. What's the health of the market like?
That's right. We're the grease. When those banks stop lending, the BDCs, business development companies, and alternative lenders are the ones that step in. And as we've talked about all year on your show, it's been a very volatile year. At points during the year, I would say it was a soft market. At points during the year, it was a hard market, meaning it was good for lenders or bad for lenders, or expensive for borrowers or cheap for borrowers. Today, believe it or not, as we conclude 2011, it's a hard market. Our rates are up. We're being able to charge 200, 300, 400 basis points more than the beginning of the year. And it's actually come full circle from what I would call a very soft market in March. And middle of the year sort of was in the middle. And at the end, we're really being able to charge good rates. We're making good loans. There's still liquidity, but I think the banks are finally pulling back. And let's talk about why, right? The shift, the banks in the beginning of the year had too much real estate. And what they wanted to do was add corporate loans. And so that caused a disparity in the market. As they added corporate loans, there was a supply-demand imbalance. Today, the banks, I think, have a good balance of real estate and corporate loans. You see the housing market starting to come back.
That's right. Saw the pending home sales numbers today.
Right. So the banks are not so worried about the real estate. With housing prices starting to rise, that's okay. So the pressure for the banks to go into corporate loans is not as high. And the Basel III requirements, of course, and the government's
greater capital requirements. They've got to hold more money on the balance sheet.
Exactly. So I think the liquidity situation, the supply-demand equation is creating a really good market for lenders.
And that means there's demand out there, obviously.
There is demand and supply, and deals are getting done. I would have missed the M&A in the fourth quarter. I would have predicted more. I think it's a bit less than I would have thought. I think there's some uncertainty in Europe and uncertainty in the markets and capital markets volatility. So maybe I would have thought it would have been a bit stronger fourth quarter. But I think next year, for example, looks pretty good.
Tell us a little bit about what's going on in terms of the ability of companies to make those loan payments. I mean, it's one thing to actually take out the loan, but you've got to make the payments. And if you say that there is demand out there and you can charge a little bit more, how's their business? That reflects on how their cash flow is.
I am amazed that the U.S. economy is as stable and resilient as it is. We expect it, and as a lender, you sort of, plan for the best.
I was going to say, hope for the best, prepare for the worst.
Right, exactly. And it's been a very interesting year where I've had to be very cautious and waiting for those problems to happen, and they really didn't. The portfolio held up very well. The default rates really aren't there. When there is a problem, our private equity sponsors stepped up and supported that problem. And so I feel like this is a really good year for lenders. It was a great year to collect our high interest rates of 10, 11, 12% interest. And it was a great year for the shareholders in terms of collecting those consistent dividends.
You mentioned the private equity sponsors, and I'm wondering if their participation in this process is a little more focused because they've got much more equity in the game now.
They do. Instead of putting 20% of the equity in the game years ago, 2007, at the top of the market, they're putting 40, 50% equity. The leverage that they're taking is 3 times to 4 times debt to EBITDA or cash flow. So that companies are not over-levered. Our country's not over-levered. I mean, this is not just the middle market, right? It's the way our banking system has gone down from 20 times leverage to 10 times leverage versus Europe at God knows how much times leverage, BNP Paribas and Francis. So that mentality, that I'm preparing for a problem mentality that our private equity sponsors are smart enough to do and our companies are smart enough to do, really creates a healthy environment for our economy to grow.
All right, we're going to leave it on that optimistic note. I want to thank you very much, Leonard Tannenbaum, joining us with a CEO sit-down as the chief executive of Fifth Street Finance. Thanks very much. Appreciate your thoughts.